Hello, everyone. Welcome to another episode of In Conversation by Advisor Coach. Today, in conversation, I have a very dear guest, Mr. Akhil Chaturvedi, Executive Director and Chief Business Officer of Motilal Oswal Mutual Fund. Welcome, Akhil, to In Conversation by Advisor Coach.
Thank you so much, Suren. Pleasure talking to you. Finally,
Our
we get
pleasure. Our pleasure. So, Akhil, jumping straight into questions, we have seen the SIP stoppage ratio from December 2024 from 83% to January 2025 at 109% and February at 122%. Of course, multiple SIPs must have matured, but pre-closure is also happening. So what do you read out of these trends? Should the industry be worried about it? And what steps should the industry take?
Suren, it is very natural. Both of us have been part of the industry now for a very long time. It's a typical investor behavior or a human psychology. SIPs, SIP numbers tend to go up dramatically in good times. At the same time, if there is a patch of a point of time where the returns are not looking good, or all the SIPs which one have accumulated over the last 12 months or 24 months, it starts to give negative to muted returns, or the markets are looking little kind of pessimist or negative. The tendency is to pause your SIPs or stop your SIPs for some time till one gets the conviction of getting back into the markets. Now, while this is not the right thing to do, because honestly you should actually develop your SIPs when things are not clear, or we are in a pessimist kind of environment, or markets are correcting, because that's how the rupee cost averaging works. But the reality is that yes, and I've been saying that in a couple of my other interviews as well, that if the market prolongs to be negative in terms of returns for a longer period of time, then the SIP numbers certainly will come down. We will have more closures than actually new registrations. And we have seen that for the first time happening in the month of Feb. I suspect it will happen also in the month of March. So till such time, the market actually gives that confidence, positivity. We go through that 2-3 months of positive returns. Maybe we will see some slowdown in the SIPs. The only caveat I would want to put is that the maturity of the investors, distributors, and the entire industry has evolved over time. So the veracity of stoppages, what would have happened maybe in the COVID time, or probably in the global financial services time, or all of these times when there has been uncertainties. I think this time around, the pace of slowdown probably could be lower, maybe 5%, 4-5% from the peak. That is the worst I would expect, because I think these are just very normal, healthy correction of the market which is happening. There is no COVID or scam or global financial crisis or something for which one has to be worried. We were slightly expensive, and we're just getting a little rational on the valuations, and therefore I feel that this should be short term, and maybe in a quarter or two things should look better. But yes, for now we will go through some numbers and some headlines on the SIP numbers for the media. But I'm not worried, honestly, too much. We've accumulated quite a bit, over the last 5 years. The SIP numbers have literally doubled, right?
Yeah,
Now,
absolutely.
after doubling, if you lose 5-10%, I don't think it's going to matter much,
Sure.
right? And hopefully somewhere mid of next year, things should get normalized and the numbers should start to move up again. So not worried about, but yes, we have to go through this,
Right.
It
So
happen.
anything collectively which the industry should do, Akhil, to your
Lot of
mind?
lot of investor awareness, a lot of investor awareness, a lot of presentation on the data points that actually SIPs work when you buy both on the downs as well as ups, and then try to really take advantage of the actual concept of doing an SIP, which is
Sure.
rupee cost averaging. Data is we have enough data now of almost 20-30 years, and that data needs to be presented, and the conviction needs to be built. In fact, generally in my conferences and seminars, I say that if you are an SIP investor, you should hope and pray to God that as long as you are doing SIP, the market should be subdued. And when you need the money, then the market should be rocketing, right?
Absolutely correct.
So it doesn't make any sense, because those who started their SIP last year and have been buying only on higher NAVs and then stopping it.
Right.
So it takes that much more time to come back. So if you bought, let's say in the last 2 years on higher NAVs, equally you should buy similar or doubler of that amount at lower NAVs, and then
Right.
the market recovers, the return looks very, very different.
Absolutely. Absolutely. So I completely agree your thoughts on this. And in fact, investors should go double down actually on their SIPs at this point in time.
Yes, yes. So, I mean, look at this. Like for the last 4 years, we've been talking about, the India growth story. Indian economy will double and triple by 2030. We should be 7 trillion, 8 trillion. So the Indian macros are looking pretty good. Yes, in between, it was little shaky, but the economic growth is coming back.
Absolutely.
The interest rate cuts are likely to continue to happen going forward. Even when you see from a geopolitical perspective, I think the wars are now coming to an end. So apart from what Trump is trying to do in terms of sanctions and all that stuff, broadly the macro data both for the world, US and India looks fine.
Mm-hmm.
On a lower base, hopefully the earnings growth also should revive over the
Look
next year.
better. Absolutely.
Post the corrections, the valuations are much more normalized, and as fund managers, maybe index may look the mid cap and small cap may look slightly at premium to the Nifty 50, but stock level opportunities are coming up. And I am seeing my fund managers a lot more comfortable now
Mm.
in terms of buying than what they were 3 or 4 months back, right? So nothing has changed in terms of numbers and long-term
No fundamentals at all.
trajectory. And therefore, like times like these are like God sent opportunity for investors like us to continue. I'm really enjoying it. I'm thinking from where I can get more money and pump in more money.
And absolutely, markets can never be linear. There are always peaks and troughs in the markets, which one has to, of course, the long term,
Yeah.
agenda kind of averages out completely.
I'm sure, like Suren, I mean, sticking on this topic, and this is also one such initiative. Hopefully, as many people hear it and
Yeah,
get some confidence from this, that you and me both, I'm sure you have not stopped your SIP, right?
not at all.
And both of us probably would be doing our SIPs for at least a 15-year or a 20-year period. You are senior than me, so maybe slightly more. So, I mean, I've become rich because of SIPs, man.
Yeah, yeah, absolutely, absolutely, absolutely.
I started off real serious SIPs in 2006. So
Mm,
2006, 7, 8 was like
mm,
buying on higher NAVs. 2008, 9, 10, 11, right up till 2013, there was no money made in equities.
yeah, yeah.
So I remember I used to put my SIP, and next month to that extent, the value used to come down. Right. So it was, there was a nice WhatsApp actually. I just remember WhatsApp which has been circulating, which says that in bull markets, your NAV compounds, and
Hmm.
bear markets, your units compound.
Absolutely
Right.
correct.
So I am of a firm belief, and I would really seriously request investors to look at unit compounding than NAV compounding. NAV compounding will happen over time.
Very well
It
said.
will happen.
Very well said.
If you have
Absolutely.
more quantity and when the NAV goes up, I mean, that's
Mm.
like a killer.
Absolutely, absolutely. Very well said. So, Akhil, when we look at Motilal Oswal Group, it resonates equity.
Yeah,
Okay. And mutual fund house, as Motilal, is a powerhouse.
yes,
That's how I at least see it.
yeah,
You've got alternates, PMS, and the mutual funds. Of lately, we've seen a lot of momentum in the alternates.
yeah.
So, what trends do you foresee in the alternate space going ahead?
So the trend is definitely positive. The trend over the last 20 years, or more specifically in the last 15 years, at least from 2013 till now, you see the PMS AUM has compounded at about 20% or so. If I just look at the pure long only equities, I'm not looking at the debt and the NCDs and the real estate part. AIF circular or AIF as a category got created in 2012. So if
Hmm.
you add both PMS and AIF, and within that long only equity, private equity, real estate, venture capital, all of this part, if you plug it together, the compounding has been more like 25% for the
That's
industry.
true. That's true.
So from nowhere, AIF is now as big as about 11.5 lakh crores in terms of commitment.
Hmm.
And PMS overall, of course, is very large at like 37 lakh crores, but about 4 lakh crores of equity, right? So,
Right.
this part of the business has been growing, and from maybe 10 or 12 serious players in this industry, 12 years back, 13 years back, today you have over 400 players in this industry, right? So
Right.
the opportunities is like what 10 times more than the mutual fund players actually, right? So there are 40 mutual funds, maybe 25 serious mutual funds, and then you have 400 PMS AIF managers.
Right.
The trend, what we are seeing now is that a lot of veteran managers or boutique managers who have come from abroad, they have unique business models, different position products. It could be pure fundamental investing, it could be quant-based investing, or it could be any other philosophy different people follow. Now that part is opened up, and if you want to really participate out of a commoditized mutual fund product, which is actually till here of all the seasoned investors, right? That extra tadka if you want in your food plate, then PMS AIF makes a lot of sense. Honestly, before joining Motilal Oswal, even I used to have this myth that all of these things are crazy things, high risk, very expensive, not friendly of towards investors. But in my 12 years at Motilal Oswal, and we have been very core serious players in alternates, there is a definite merit I see in our alternate products. Like at least if I have to talk about ourselves, our alternate products are all designed towards certain themes we are trying to play, which we
Mm-hmm.
don't do in mutual funds. So mutual
Mm-hmm.
funds are all about large cap, mid cap, small cap, multi cap, etc. But if you see our alternate book, it is all about playing the India next $1 trillion story, or playing the value migration theme, or playing the mid to mega theme, or playing the founders theme. Now, if you want to invest only in Indian entrepreneurs, businesses owned by entrepreneurs creating wealth over long term, then you have only product which is the founders theme product at our end, right? So we have differentiated. The core belief, philosophy, policy remains the same, but the portfolio creation changes between a market cap oriented product or a thematic product. And
Sure.
then, like I said, there are quantitative products and there are long shorts and many other things which are at play. So that's one reason that there is a wider choice available for investor to diversify the HNIs now, because the minimum is at 50 lakhs and 1 crore. To get a lot more differentiated products, more wider diversification across managers, newer opportunities, newer asset classes. These have been some of the reasons where we have seen that the larger clients have put allocation. And another point which one has to keep in mind is that the HNI population in India also has compounded and grown over the last 10 years, more specifically in the last 10 years, right?
Very true.
Whatever last Hurun study I had seen that there are over a million Indians who have a net worth of $1 million and more, right? I think it was 7 lakh Indians. Now I think it is about a million Indians who have a
Mm-hmm.
net worth of $1.5 million and more. And then you can dissect. We have like 150, 160 billionaires and so on and so forth. So the wealth compounding has also happened. And now, do you think that this is going to go down, or India is only going to get richer? If the economy is going to get larger and larger and larger, it's very obvious that you will have a larger middle class population. You will have virtually, we know that 250 million people are out of poverty. Extreme poverty is completely eliminated. So I think in the next 10 years, you'll have a larger pie in the middle class, which will be like mutual fund oriented, and then the top. Currently 4-5%, the rich people should go up to like 12%. Now these rich people obviously also are the main guys who actually are investing into these alternate ideas, and I'm going to see I'm foreseeing a lot more innovation on the alternate side.
Right.
Looking at the growth story of the PMS and AIF, you look at SEBI, which is also creating a new opportunity for alternate products within the mutual fund umbrella. So the SIF, the specialized investment
Nice.
vehicle, itself now, as per SEBI, there are 7 new categories which are getting created. You can use to some extent derivatives and create differentiated product offerings at a lower ticket size. So you're giving an opportunity to a affluent investor also to participate into slightly differentiated product from a plain money. I mean, how much
And also bringing him back to the regulated way of managing rather than unregulated way.
everything is regulated, but here, given the mutual fund kind of a framework, the
Right.
regulation is more stringent. So
Absolutely.
because you have reduced the ticket size, therefore the regulation has to be a lot more tighter. But I just believe that in terms of diversification, it gives emerging rich people who are now comfortable in putting 10-20 lakhs but couldn't do a PMS or a AIF, can look at these products, which will now
Absolutely.
over the next
Absolutely.
so if the regulator is promoting specialized products, you have existing vehicles, PMS, AIF, a lot many managers, and then the SIF which is getting created. So I think there is going to be a lot of innovation, a lot of differentiated product offerings across asset classes, and therefore I feel that the alternate pie will compound at a higher rate than the plain vanilla mutual fund compounding, because at a base that's like very
That's
very
right.
great, right? That's
That's right.
like 55 lakh crores of equity on mutual fund, and you're talking about 5-6 lakh crores of pure equity on alternate. So at a lower base, the compounding obviously
It's much higher, obviously.
slightly higher.
Absolutely.
So we are quite excited on this space, and we'll continue to bring about innovation, whatever we understand. Like we've gone into quants also now,
Right.
right? We are excited about this, yeah, honestly.
Interesting times ahead, I must say.
Yeah, absolutely.
So what are your thoughts on the, the gift city and how is it shaping up?
Now, Gift City is another boon to managers and investors, especially the NRIs, honestly, because uh, plain simply talking, for managers like us, the only way to get global money, whether it is NRIs or whether it was FIIs, was basically through the Mauritius route or the UCIT route, right? Now UCIT is very cumbersome, very expensive. You don't have too many players out there, right? So because it's like following another continent's regulations, and so it needs a separate investment. But the easier way was the Mauritius way, and
Right.
Mauritius really couldn't actually scale up. I mean, I don't know any manager who's become like a billionaire over there, right? Now there were a lot of limitations because one, India was always a challenge, rupee depreciation was a challenge. In Mauritius structure, you had the ceiling of 49%, beyond which the NRIs couldn't invest. So NRIs are the most easiest target because they understand India and they want to invest in India. They have NRE NRO account where they can put rupee, which they are putting, but
Right.
a large part of their money is in dollar, which they could not bring into India, right? So all these issues have been plugged in by GIFT, fortunately. So the moment last year, the regulator at GIFT, which is IFSCA, announced that there will be no limit for NRI in a GIFT City fund, that is within 1 month I launched the fund, because the limitation I was facing in Mauritius and most of us were facing in Mauritius is plugged out here.
Mm-hmm.
Right now, apart from that, let's say the feeder structures, which where again, if a gift vehicle is investing into an Indian mutual fund, and Indian mutual funds are a pass-through vehicle.
Mm.
So, when a redemption happens and if you have invested in a feeder structure, there is no tax at the fund level, right? It goes at the investor level. So, somebody who's sitting in a GCC country doesn't have to pay any tax. Or
Mm.
if somebody is sitting in a UK or a US, you have to pay whatever tax you have to pay. At least we are giving back whatever your mark to market, take your money and go back.
Absolutely, yeah.
Unless this kind of a offering which was available, we had to get into the taxation calculations, give the breakup of long term, short term. We have to issue a K1 to a US investor. So a lot more compliances, and it was also one element which used to keep investors away. So
Right.
I think taking out this 49% restriction, the tax-free structure for a feeder fund, uh, even in terms of operating expenses, we are seeing while it's not a lot, but we see a 40% decline in the operating expenses. So, for example, a Mauritius structure would cost you like a 25 bips, manage OPEX. Here it may be like 10-12 basis point, right? So your
Mm-hmm.
OPEX structure comes down.
Come down, yeah.
GST is not applicable on the management fees. So these are small
Benefits.
areas where your gross return keeps coming down basis all of these things. And then we are in India. I mean, it's a special economic zone within India, but within India, right? So far more comfortable, a lot of support from the regulator. And I think this is just evolving. And the regulator is very, very open towards taking feedback. Now you
Mm.
see that if you have to launch a fund very recently, we had to have a minimum of 5 million to activate the fund. Now that has been brought down to $3 million. And out of 3 million, you start with 1 million, 3 million you can do over 12 months. To activate a fund was a task, getting $5 million
Yeah, in one go,
one
yeah.
day. Otherwise, how do you manage somebody who gives you 150,000 and he waits till that
No,
5?
this has really opened the gates,
So
actually.
this has opened the gates, right? And so very early days, it's like, our industry, mutual fund industry back in early 90s or something. It's that early. But I think India, again, as a country, is now being top five economy, will create a lot of investment opportunities, not only for NRIs, honestly. of late, we are getting a lot of inquiries from so many sovereign funds,
Hmm.
family offices, and from across the world. I mean, I've spoken to people from South Korea, Japan, China, Middle East. So many inquiries are actually on the table right now. Due diligences are on, and
Hmm.
and again, a lot of the Indian mutual funds have started to create their structures in GIFT, right?
Right.
The beauty is now, I think creating a direct fund doesn't make sense, at least for somebody like us who has Indian mutual funds. Keep creating feeder structures. So
Mm.
I have a multi-cap rupee denominated, I have a multi-cap dollar denominated, I have a mid-cap rupee denominated, I have a mid-cap dollar denominated. So the dollar guys can go to dollar, the rupee guys can come to rupee. Life is easy, compliances are cool, costing is low, onboarding process is good, and then there are several platforms where these products are available. Digital onboarding is possible. Just like you buy on a MFU or a Paytm or a Grow or Zero, there are platforms which are available where you can simply buy this
True.
completely digital, right?
True. True.
So
True.
again, for us, we've been lucky. It's just been 7-8 months. We launched our first product. It was the fastest $100 million.
Hmm.
Now imagine this, okay? My Mauritius product launched in 2016. We are in 2024. It is less than 20 million.
And this one is already crossed 100 million.
It's already crossed 100. In fact, I'm shutting down that structure and I'm moving all the investors out here.
Right.
As we
Right.
speak, the process is on, and 31st March, I'm going to cut that structure.
Right.
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 So now it's only GIFT.
Right.
Right. We are in a stage where we are now looking at actually investing in infrastructure outside of India. So we have our board clearances. So I think over the next 3 years, we will create a lot of platforms outside of India to bring money back into India. So
True.
that's one opportunity. And to conclude our GIFT discussions, the outbound opportunity is also emerging opportunity. So for
Hmm.
you and me to go outside of India and invest through a GIFT is now a big potential, big opportunity, which is
And
also
very easy.
which is it's very easy. So that's something which we are also on the drawing board, and I'm sure you'll have plenty full of options for
Yeah.
Indians to go abroad, outsiders to come in India. So I think we are lucky. Yeah.
So, Akhil, Motilal Oswal Mutual Fund has a good blend of active and passive funds on the mutual fund
Yeah.
space, right?
Yeah.
So, are you seeing any shift in investors moving from the active to the passive side? Just
I'm
some
not looking to
thoughts on that.
shift from active to passive. I'm seeing that the active guys are also looking at passive.
Right.
Right.
Okay.
So incrementally, maybe 5 years back, I used to do only active, 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 active. Today, some part of my portfolio is also in passive. Why
Right.
do I put money in passive? Because, now again, just like alternate products in passive, also the opportunities have emerged. A lot of new ideations,
Hmm. Hmm.
new thematic funds. A lot of innovation is happening on the passive side, which is gaining a lot of traction of one, the emerging investors, the young emerging investors. Two, large investors like institutions and family offices. So like in our case, if you see, while on one hand we have created our basic indices, which is Nifty 50, Next 50, Mid Cap 150, 250, Micro Cap. So all now, see, if you want to buy Micro Cap 250, you don't have an active fund.
Hmm.
Buy the passive.
Absolutely. Hmm.
We are in a age and date where there is really tough competition with the benchmark. So there are times when there is alpha, there are times when alpha is not there. So I
Hmm.
keep telling people, why not? If you're investing, if you want to put money in a flexi cap fund and Nifty 500 is your benchmark, you never know that the flexi cap fund will always outperform a Nifty 500. So I'm saying that I have 80% active, 20% Nifty 500 index. It's just like any other fund. Sometimes it may outperform, sometimes it may underperform, but it helps you in diversification.
Yeah, very true.
But then themes like defense, capital markets, healthcare, now these are the building blocks where now today if I feel that banking looks very attractive, simply go in you can take a tactical bet, put 10-20% in banking, make money, get out of it.
Right.
So
Right.
people are understanding that a lot of knowledge related activities are going on by asset managers. I'm seeing positively very good acceptability by the distributors also.
Right.
They are
Right.
very open. They are understanding. Otherwise, there was a time I have seen it was like a fight.
Hmm.
If you're doing passive, which means you are against distribution and you are against investors and all that stuff. At least that
The
part is
trend is changing. The trend is changing
and the trend is changing. So
completely.
therefore, we are seeing growth. Like now, 30% of my AUM is passive.
Hmm.
If you remove Nasdaq and S&P 500, 15% of my AUM is passive. We
Hmm.
have a significantly large SIP book of almost 200 crores, which is 20% of my SIP book actually is in domestic passives.
Hmm.
Other 200 crores is registered for the international funds. Unfortunately, we cannot take right now. It is paused for some time. But if you add both of those things, 40% of my SIP book is actually passive SIP book.
Right, right.
So it's small emerging right now. Okay, I'll tell you one more thing. We are actively promoting Nifty 500. Now, we are actively promoting Nifty 500 to retail, HNI, to that extent, even to large institutions who put pension funds who are
Hmm.
putting all their large cap allocations to Nifty 50. Now, what we are saying is that you buy a Nifty 500 fund, it is 82% of Nifty 50.
That's right.
18% of a dash of mid and small is helping you get that additional 1.5% extra return
And
compounding.
move to the broader market side as well.
And it is not really adding too much on your standard deviation or beta or anything like that. So it's not really accelerating your risk for that higher return. It is increasing your return with a lower risk.
Yes.
So we are saying that if you want to take large cap, might as well you move to Nifty or at least move 50% to Nifty 500. Take a dash of mid and small and take that 1.5% extra compounding.
True, true, true.
So we're doing a lot of activities, a lot of presentations to even the pension funds
Hmm.
typically tend to blindly go towards Nifty 50. It takes time for everything to happen, but those are the kind of opportunities I feel,
Are available.
which are
Absolutely.
going to become very large. Matlab, Nifty
Yes, yes.
500 is the biggest benchmark.
It's
So
biggest benchmark. Absolutely.
technically, it should be the biggest AUM.
And very widely covering the broad
Yeah,
markets.
yeah, yeah. For example,
Yes.
in every category, honestly, Suren, I'm practicing, so I have to preach what I practice. In every category of my mutual fund investment, I bought one passive. So I have multi cap, I have flexi, I have a small cap 250 SIP, I have a mid cap 150 SIP. The international is stopped for some time. I have a micro cap SIP. So in everything, I've just created a small layer, like a 10, 15, 20%. I
Correct.
bought thematic, so I liked recent the factor strategies on the
Correct.
passives.
Strategy.
That's very very interesting
That's
because
very
you have
interesting.
four factors. You have a quality. Now quality is outperforming all other baskets.
Yeah.
I mean, let's say next 6 months, 1 year, buy the quality basket, make it 20% of your portfolio, and that will help you one protect your downside and get that extra return.
Yeah.
Maybe a year like 2022, 23, buy momentum, it will give you that 1-2% extra return. If you feel markets are too volatile, buy the low vol, it will protect your volatility,
So
right?
much of choices for the investor and distributor today.
So actually, the evolved investors understand all this. But for the distributor and my distribution friends, they are the experts and they need to take interest in understanding this
Yes.
whole basket. It's not easy. So if you have to grow your business, and this is where when we talk about growing your business, you have to understand more lines of product, more lines of opportunities. For example, passives, factor strategies, derivative strategies, different asset classes, PMSs, AIF, gift city. The more products you have under your umbrella and then you meet a wider set of audience, one, it can help you add more investors. Secondly, it can help you get a better market share with your existing investor. That's how you grow
Absolutely
the
true.
business here.
Good
So
deep down. Correct.
yeah, so
Absolutely.
these are some of
No,
my thoughts here, honestly.
no, no, very interesting. Very interesting. So, Akhil, today through this in conversation, and typically when of time when we go into a lot of these geopolitical and geoeconomic activities around, what one quick message you would like to give to investors, distributors, advisors in the current market situation?
So my advice would simply be that you don't have one size fit all for a product or asset allocation for all
Hmm.
investors. I mean, typically when we talk about mutual fund, it is all about equities. Actually, it is not all about equities. It shouldn't be all about equities. I would suggest that we are in a world where things are very, very different. Things change overnight. There are geopolitical concerns. Sometimes there are war-related issues. Sometimes there are economic wars. There are political wars, and there are actual wars which are happening. Then the macro environment keeps changing all the time. A lot of innovation is happening across the world. I mean, for example, suddenly the IT sector looks, the traditional conventional
Hmm.
IT looks
Hmm.
very muted. The AI is trying to kill that industry,
Hmm.
right? So much of innovation going on. I think distributors and investors should try to create like a, I like what Radhika talks about at Edelweiss, that you should have a thali with, different vegetables, different dal and all that stuff. She says that. So just to make it more simple, I think, you should have equity, you should also have fixed income, you should also have gold, you should also have, some differentiated offerings. So different investors need different kind of recipes, different kind of thali options. I was in Chennai, and I was staying in Taj, and they have a lovely South Indian restaurant, right?
Hmm.
You have I thought there's only one thali option in South Indian restaurant, which is like that very, elaborate kind of thing. So I told, and I was alone, sitting alone over there. So I said, yeah, boss, I can't eat this whole thing. So she said, don't worry, sir, we have a mini thali option available. Yeah, no, mini, so that was like perfect. And so, so different people have different expectations.
Yes,
I think we need to move towards, have to have your open mind and
true.
be fairly diversified. Yes, you can. It's like a, if you are driving a car on the highway, you can go on the fifth gear, but if you are in the road, you will shuttle between first, second, third gear also.
Yeah, yeah,
So
yeah.
your allocation in a certain particular asset class, depending on the opportunity, can go up and down. But it cannot be that you are at one stage 100% equity, one stage 100% debt, one stage 100% gold, 100% silver, 100% PMS, 100.
That's right. That's right.
It's a
That's
way
right.
ना ये just chasing the return से भाई eventually 12-13% कंपाउंडिंग चाहिए 10-15-20 सालों में.
Yes,
Right?
absolutely.
अब उस पे स्टिक करो ना कौन सा मार्केट कहाँ है कहाँ नहीं है. I think that you and me can do it because we are professionals in this industry. We understand, right? Our mental, customization is different, and we have been long-term
Completely.
investors. But these new investors, like if I talk to mom, dad, my uncle, aunties, and all, they don't understand a shit, So you have to you have to balance it out, right? So there's a lot of responsibility at the end of distribution, and I
Yes.
always tell everybody, all investors, that they must have distributors, advisors, somebody to navigate them through all
Hmm.
those
Hmm.
things.
Absolutely.
DIY is, unless you understand all those things, I
Yeah,
think
yeah, yeah.
avoidable.
It's a road not to venture unless you understand everything very well.
And personally, I have somebody in between. Although I understand, there is a saying that a doctor cannot cure himself, right? A
Yeah,
doctor
yeah,
also
yeah.
has to go to a doctor.
Very
So
true.
I have two advisors. One gives me alternate ideas, one gives me plain money mutual fund ideas. So I balance between the two, and they take care of everything here. I mean, I don't have to bother.
Very true. Very true. Very true. Wonderful. So, well, for our viewers, this is Mr. Akhil Chaturvedi, Executive Director and Chief Business Officer with Motilal Oswal Mutual Fund, sharing his thought around multiple aspects, alternates, SIPs, Gift City, active, passive, and is, of course, the quick advice also which he gave. So, Akhil, thank you very much for joining in today
Thank you, Suren. Thank you
and
so
sharing
much.
your wonderful thoughts and for your time as well.
No, thank you for the opportunity. Always a pleasure talking to you.
Thank you very much.
Thank you. Take